This LOS is describe the basic principles of capital budgeting. Basic principles of capital budgeting. So here's a list with 6 items. Number 1, decisions are based on cash flows. So we do discounted cash flow calculations. Number 2, timings of cash flows is crucial because they're being discounted back to the present value, so timing is important. Cash flows are based on opportunity cost. What are the incremental cash flows that occur with an investment compared to what they would have been without the investment? So in capital budgeting, we're looking at incremental costs and incremental revenues, and they're based on opportunity cost. What else could we do with those funds? Cash flows are analyzed on an after-tax basis. Taxes must be fully reflected in all capital budgeting decisions. Number 5, this is an important one to understand, financing costs are ignored. This may seem unrealistic, but it is not. Most of the time, analysts want to know the after-tax operating cash flows that result from a capital investment. Then these after-tax cash flows and the investment outlays are discounted at the required rate of return to find the net present value. Financing costs are reflected in the required rate of return. So you're discounting back at a required rate of return, which includes the cost of debt, for example. So by including debt expense in the analysis and then discounting using a discount rate, also including the cost of debt, you'd be double counting. So that's a really important one to understand. Financing costs are ignored. Financing costs are reflected in the required rate of return. And finally, the 6th principle of capital budgeting is that capital budgeting cash flows are not accounting net income. So continuing now with the basic principles of capital budgeting, we're going to look at some definitions. So first, a sunk cost is one that has already been incurred. You cannot change a sunk cost. An opportunity cost is what a resource is worth in its next best use. For example, if a company uses some idle property, what should it record as the investment outlay? The purchase price several years ago, the current market value, or nothing? If you replace an old machine with a new one, what is the opportunity cost? If you invest $10 million, what is the opportunity cost? The answer to these 3 questions are respectively the current market value, the cash flows the old machine would generate, and $10 million which you can invest elsewhere. An incremental cash flow is the cash flow that is realized because of a decision. The cash flow with a decision minus the cash flow without that decision. An externality is the effect of an investment on other things besides the investment itself. Cannibalization is one externality. Cannibalization occurs when investment takes customers and sales away from another part of the company. Conventional cash flows versus non-conventional cash flows. A conventional cash flow pattern is one with an initial outlay followed by a series of inflows. In a non-conventional cash flow pattern, the initial outflow is not followed by inflows only, but the cash flows can flip from positive to negative again. And there I put a star. I said, note, normally a higher discount rate makes for a lower NPV. However, when there are large negative cash flows again in subsequent years, that's not the case, and you have to be very careful and work through the calculations with the calculator. So we'll finish this LOS with a practice question, as we sometimes do. With regard to capital budgeting, an appropriate estimate of the incremental cash flows from a project is least likely to include A, externalities, B, interest costs, or C, opportunity costs. The correct answer is B. Costs to finance the project are taken into account when the cash flows are discounted at the appropriate cost of capital. Including interest costs in cash flows would result in double counting the cost of debt. So again, with regards to capital budgeting, an appropriate estimate of the incremental cash flows from a project is least likely to include B, interest costs. And that's the last slide for this LOS. Thank you.